The next panel is on navigating shifting geopolitics of oil and gas. Members of the panel include, from the right, Mr. Osman Shahenshah, CEO of Afren. Then we have Mr. Robert Johnston, Director, Global Energy and Natural Resources Practice, Eurasia Group. Then we have Mr. Benjamin Dell, Founding and Managing Partner, Kimmeridge Energy. Mr. Michael Levi, who is David M. Rubenstein Senior Fellow for Energy at the Council on Foreign Relations. And the panel will be moderated by Dr. Jonathan Chanis, who is an adjunct professor at the School of International and Public Affairs. Dr. Chanis has worked in finance for more than 25 years, spending his time mostly in trading and investing in the emerging markets and various commodities markets, especially oil and gas. He is a member of the Council on Foreign Relations, a member of the board of the Energy Forum, and a trustee of the National Committee on American Foreign Policy. I request Dr. Chanis to initiate the discussion. Thank you very much.
Hi. What I'd like to do today is just have every speaker speak for a few moments. You've heard a little bit about me. I'll just say a few things about the speakers, and then we'll have some questions among ourselves, and then open it up to you. But the one thing I want to say before we start is that something really has changed in the geopolitical world of oil and gas, and in the world of oil and gas. For those of us, I think, on the panel, I can look at people's ages. Some of us remember 1973 and 1974. And something really changed in 1973, 1974, and that world really existed until several years ago. When you were in this business of oil and gas over those decades, things really didn't change very radically. It was a world of scarcity, of energy insecurity, of people in the United States being very, very concerned about how they were going to source their oil and gas. And you can go in and out of the business at any point in the 1980s and the 1990s. You came back in, and the same things you looked at in the 1970s were the things you looked at in the 1990s. But about 4 or 5 years ago, something really radical changed, and that, of course, is the so-called oil and gas energy revolution. And it really is something very different, and the world has caught on to what this change in the physical production of oil and gas means. There are some controversies about it. Maybe we can get into that. But the second part of that is what does the energy revolution mean for the geopolitics of the United States and the geopolitics of the world? People are still really coming to grips with that aspect of the change in the energy world, and there's a lot more controversy and a lot more divisions of opinion and views on what this means for the foreign policy of the United States, for example. So why don't we first start with Osman Shahenshah, who is the CEO of Afren and has some specific views on this.
Okay, thank you, Jonathan. I'm going to make a few remarks that are probably very different from what my fellow panelists will offer, because I'm going to give you a company perspective. Afren is an exploration and production company operating mostly in Africa and in the Kurdistan region of Iraq. And there are two things that I think are quite interesting for the geopolitics that I think we'd like to discuss today. One, let's start with Kurdistan. Turkey currently is a country that is energy dependent on Russia, on Iraq, and Iran primarily, with some LNG from other sources. Turkey has a difficult relationship with Russia. It has a historical relationship with Iraq and a fairly friendly relationship with Iran historically. It also has a cultural dilemma with respect to its Kurdish population. We now see what's happening in Syria. I think about 30% of the Syrian population is displaced, and about 10% of the Syrian population are refugees in northern Iraq, Kurdistan, and in Turkey. So it creates an interesting situation in the region. Turkey is on the verge of importing between 1 and 2 million barrels a day over the next 5 to 7 years from the Kurdistan region of Iraq. This is supply that hasn't been there in the past. And when that happens, I can see a situation that could create tremendous instability in the region, largely because the federal Iraqi situation is held together by a very loose and poorly aligned coalition. And to the extent Turkey decides to go with Kurdistan and seek energy independence through its relationship with Kurdistan, I could see the situation in Iraq and therefore Iran, which is to a certain extent supporting Maliki and the Iraqi situation, I could see Iran becoming more isolated. So this is a situation that I think will develop over the coming months and years, but could create tremendous instability in the region, which could affect Russia, Syria, ultimately Israel, and that means the United States and Iran. So that's one comment that maybe we'll talk about a little bit later. That's also affected by the new hydrocarbon discoveries in the Eastern Mediterranean. Maybe we'll discuss that a little bit later as well. The other thing, just to pick up on Dr. Chanis's initial remarks, is something that I've seen in West Africa, where we do quite a lot of work. And in, I think, 2008, West Africa accounted for the largest single import percentage of U.S. imports. It was about 23% of U.S. imports came from West Africa, which is more than Saudi Arabia. And people didn't, quite realize that Nigerian and Angolan crude was constituting that much. That's fallen about 50% in the past 5 years. So a significant portion of West African, and this applies to other countries, but of African exports to the United States has had to be diverted primarily to the east. And that is largely driven by the energy revolution, the growth in unconventionals in the United States. That has, in my opinion, some very far-reaching implications on governance, on the tax rates, on what countries do to attract oil and gas investment. And we'll talk about that a bit more, but those are two real-life examples that I see that have emerged from the energy revolution and the dynamics of the Middle East.
Great, thank you very much. Next, I'd like to turn to Robert Johnston, who's with the Eurasia group, to just give us a couple of minutes of what you think is important about the geopolitics of oil and gas.
Thank you very much, Dr. Chanis, and thanks for inviting me here today to Columbia. Very happy to be here. Just to pick up on the opening comments, I think that thinking about geopolitics of energy from two perspectives. I'm based in Washington, and you can talk about what I think is happening there, and then maybe pick up on some of your comments about the global implications of what is still, for the most part, a North American energy revolution, but quickly becoming global as well. From a Washington point of view, I think the points at the beginning about a cycle of politics that began in 1973 is a very important one, right? That really, the oil shocks of the 1970s really created a focus in Washington, a mindset about energy security, very inextricably linked between energy and security, particularly for oil and refined products. And we're starting to see that as a result of the energy revolution in North America, the shale gas and tight oil boom, that's starting to change, but it has not yet completely changed. It certainly has changed radically in natural gas in the sense of a new narrative of energy abundance, replacing the old narrative of energy security, indicated by the fact that we've actually permitted LNG exports out of the US. So concerns about policy focus on how to manage this abundance of natural gas supply, call it 100-year reserves, call it 80, 85 BCF a day of production. But that narrative has changed. On oil, it is changing, but it's not yet fully changed. I would argue that the roots of energy security on oil in Washington are much deeper and will take more time to evolve. So I don't think we'll be exporting crude yet. If this production growth in the US keeps happening, perhaps for another 2 or 3 years, then maybe the next president will be looking at crude exports the same way that Obama's had to deal with the issue of LNG exports. But in the meantime, I think policymakers in Washington say, I'm seeing all kinds of different production forecasts for the Bakken and other big US tight oil plays. I don't really know if this revolution in tight oil is as big and dramatic as the one in shale gas. So it's starting to evolve in Washington, but there's still a lot of that 1973 mentality in place. Secondly, in terms of the international impact, I agree that the displacement of West African barrels from the US market is a major development and has a big impact on markets and on refiners and moving more light sweet barrels into the Asia Pacific market. But it was really the second point that I wanted to pick up on, which is how do other producers around the world respond to the opening up of opportunities in the US? Particularly when we're seeing a sort of an onshoring of so many US big exploration and production companies, the ConocoPhillips of the world, the Occidentals, the Marathons. Many of these companies, Devon, have significantly reconcentrated their capital back into the Bakken, into places like Alberta, into places like Texas and Oklahoma as well. So that shift is quite significant because it basically means there's fewer dollars out there chasing some of these opportunities. So the ability of governments that might have resource nationalist inclinations to extract very punitive terms from investors, from international companies, has probably declined. And some governments that have been traditionally resource nationalists, like Russia under Putin, have actually become a little bit more, at least incrementally more flexible, particularly as they try to access expertise from the West to get into things like tight oil and their own Arctic oil plays. So I think that that's one effect that we need to think about. North American energy revolution certainly impact prices globally, but also the strategy of many of these other host governments. And I look forward to discussing that in the Q&A.
Thank you. The next person is Benjamin Dell from Kimmeridge Energy.
Thanks, Jonathan. I actually wanted to try, just in my opening remarks, bridge some of the commentary from what you heard this morning to the discussion on geopolitics. And I shall caveat this as this is coming from a producer of US unconventionals as opposed to someone looking in. And as I heard someone say yesterday, it's like asking a fisherman about the weather. He's in it all the time, but he doesn't really study it. So this is just my personal commentary. I think what's interesting is you've heard about this revolution in unconventional oil and gas. And the focus has been growth in gas production, growth in oil production as it coming, US energy independence. And I think when you actually look at what's driven this, it's a combination of technology, horizontal drilling, fracking, et cetera, which you've heard about, geology, opening up or the revisiting of mature basins. But something that very few people have discussed this morning is that it's been driven also by commodity prices. To give you an idea, the average capital spent per barrel discovered in the US has gone up 8-fold in 15 years. These are not cheap barrels. These are not easy barrels. If you gave me a large anticline with high porosity, high permeability like Spindletop, I'd drill that first. The reality is these are high-cost, complex barrels, whether it be subsalt, deep water, unconventionals, low porosity, low permeability rock. And the reason I bring that up is because we sit here, I think, in the next hour discussing the geopolitics and the role that the changing, what we're all really discussing is the changing market dynamics. Does the US become an exporter of LNG? Does it build new relationships with Europe? Does it displace Russia for natural gas? What happens in the oil market? Does Saudi exports to the US drop? Does West Africa drop? How do these dynamics change? Even the Turkey, Iraq, Kurdistan discussion. And truthfully, when you look at these are all price dependent. At $50 oil, at continued $4 gas, the US isn't producing and growing gas and growing oil. At $150, $170 oil, the US will grow oil rapidly and become a major exporter. If the US is allowed to export LNG into price markets which are priced at $15 to $18 an MCF, it'll become a major supplier. If you get West Coast LNG, it'll become a major supplier to Asia. So I think as we discuss the geopolitics, which are clearly changing, you have to put it in context of the price environment. And I think you also have to put it in context of the fact that the US is a marginal producer of oil and gas and requires high prices to do that. And my view would be that if you have continued high prices, and if the marginal cost of supply continues to escalate, the US will be increasingly important in an exporter of both potentially refined product, natural gas if it's allowed, and potentially oil if it's allowed. But this could rapidly change, and the direction of these relationships can shift. And I think 10 years out, we'll be sitting here, and the only thing I know is that the majority of us will be wrong.
Thank you. The next speaker is Michael Levi from the Council on Foreign Relations.
My goal will be to prove Benjamin's last point right. Make three broad points. We're seeing extraordinary changes in US oil and gas, which are good news for the economy. They are helping national security and are a mixed bag for the environment. But as we think about them, I think we need to be very disciplined in thinking through the consequences. On the oil front, if you would have asked anyone 5 years ago, they would have said energy independence is a nonsensical thing to think about, and they would have had two reasons. One was that we could never produce as much as we consume, and the other is that there is a global market for oil, with some variations around the edges, but generally a global market for oil that you cannot step off of. That first assumption has changed in recent years, that maybe we could get toward self-sufficiency, at least in North America, but that doesn't mean that the second piece has changed. We still remain part of a global market. That means that we are still exposed to events around the world, including disruptions in the Middle East, rising demand in Asia, pushing commodity prices up. All of those pieces remain. So we should be very careful to run from this world where we worry about the price of oil and the impact on consumers to one where we've convinced ourselves that we are swimming in oil, it's an age of abundance, and let's figure out what to do with it, and constraints be damned. So that's the first basic point. The second is there are very few commonalities that are useful in thinking about oil and gas. It's more useful most of the time to think about them separately. There are places where they overlap. You have gas, associated gas produced alongside oil. You have the potential for natural gas to move into the transport world. But oil and gas are very different. And in particular, the natural gas world is still a regionalized world. You have a North American market, you have a European market, and you have an Asian market. And there's some interconnections between them, but they're still largely their own pieces. And part of what that means is that big changes in the regional supply-demand balance can have much stronger geopolitical consequences in the natural gas world than they do in the oil world. So US self-sufficiency in natural gas does have a bigger impact on US security than increasing self-sufficiency in oil. The freeing up of natural gas that would have come to the United States and is now heading into Europe does change geopolitics in Eurasia by strengthening European consumers in their relationship with Russian producers. So gas and oil ought to be thought about differently. Last basic point that I think is essential to keep in mind, particularly on the oil side, is that while the material reality is important and trade patterns and prices and all these pieces are important, so are leaders' perceptions of what's happening. And this runs a bit against the first thing I said. Even if the United States will not actually be isolated from the rest of the oil world, if policymakers become convinced that we will be, they'll take steps based on that that will have real-world consequences. And that's true not only in the United States, but for other countries as well. If Saudi Arabia becomes convinced that we will be less interested in their future because of what's happening in American energy, they will take steps as a consequence that will have real-world impacts regardless of whether their belief is right or wrong. If Chinese military planners come to the conclusion that they can't count on the United States for sea lane security, or if Indian or Japanese planners come to similar conclusions, they'll take steps that will have their own impacts regardless of whether those assumptions are right or wrong. So paying attention not only to the material impacts of what's happening, but to how leaders and decision makers are responding is really essential to understanding where we're heading.
Thank you. Why don't we start just by talking about a few of the common themes that were just raised. And I guess the first thing I'd like to ask Mr. Johnston and Mr. Levi is, if you were the policymaker, would you push the United States to become fully integrated into the global oil market, not gas, just oil? Because for people in the market, and people who really understand the market, they know that there are markets and there are markets. There are markets which are more free, markets which are less free. And obviously the global oil markets, it's really not a single market, markets are not really free. There's a large oligopoly which tries to control the price. There's all kinds of distortions about destination restrictions. So the idea of crude exports and just letting the United States fully integrate into the market, would you Mr. Johnston, would you think that's a good thing?
I think it's, one could suggest it's a good policy potentially, but it'd be political suicide probably within the next 4 or 5 years. I think that the roots, as I mentioned, of the perception of the U.S. as being oil dependent and competing globally for barrels are very, very deep and be very hard to change. So it could be that a candidate or senior policymaker who advocate that position would be seen as sort of a creature of the oil industry that's looking for higher prices. It'd be too easy to demagogue it that way. So there's a domestic politics angle to it. As policy, I think it does make sense, potentially, if the production keeps growing. And there's questions about getting basically the right crudes to the right refineries in the most efficient market-based way, which is not happening right now because of the restrictions on crude exports. I do think an angle to watch here is to what extent, as the U.S. enters into, well, we're already in strategic negotiations on trade with Asia and with Europe as well, will these energy trading restrictions come into play? Right now, you do have national security exemptions that can be invoked and so forth, but I think increasingly, as the Europeans and Asians look at the U.S. as a low-cost energy story and a manufacturing advantage, there'll be more pressure to get access to U.S. supplies through trade policy.
Well, Michael, do you want to answer first?
So first, I think there's an irony here in that if a bunch of countries weren't restricting their oil output in order to keep prices high, we wouldn't be having this US oil boom, right? The prices wouldn't be there to support it. So we should keep that piece in mind. Look, I think that the market generally, in this case, the market will generally get you a better economic outcome, even though there are these various distortions there. I think that the restriction on crude oil exports probably does not have a huge macroeconomic impact. Ultimately, if you kept exports restricted, you would have to have some new investment in different kind of refineries. Some people would write off some previous investments that were no longer worthwhile. You'd have some more pipelines built. There would be some deadweight loss to the economy, but I don't know the impact would be that big. I think one of the pieces people are missing on this, I think RJ is right that it's dangerous politically to say you want to allow oil exports. I worry on the flip side that if we do have a bar and it does create significant distortions, it really sets up a zero-sum game between oil producers and those who want to promote better fuel economy, more substitution of alternative fuels. If you have these constraints, you create a zero-sum political game there. And I think you should expect in that world to see oil producers who have been kind of okay with things like stronger fuel economy standards in recent years become much more hostile to them. I think we ought to look ahead and worry about that.
Let me just ask you, though, in a hypothetical world, an ugly world, a year from now, 5 years from now, the Straits of Hormuz are closed, and the world loses 16 million barrels a day of production for a week or a month or 3 months, whatever. If the United States has the ban on exports in place, and with the treaty in Canada under NAFTA, isn't the United States still better off, or wouldn't the price impacts be slightly less here, and wouldn't the physical supply, even at a higher price, be much more assured with the export ban in place?
If we were self-sufficient at that point?
Effectively, yes.
But if we had an oil export ban, I'm very skeptical that we would get to the point of self-sufficiency. Right? I mean, a precondition is taking that price from the rest of the world. Right?
Well, there is, the linkage comes through, the system isn't closed, the linkage comes through the refined product market and the exports.
It doesn't. I mean, you have to look today at the spreads you're seeing between WTI and Brent, which are not just being driven by infrastructure bottlenecks right now, they're being driven by oversupply in the domestic market and the inability to get that crude into the product that you want it to be, which is the refined product for the gasoline market, et cetera. So if you look at the US market today, to actually get to a true energy independence, so to speak, you'd have to massively ramp up your refining capacity, change the structure of that market. Even if you look at the natural gas business, you have the same thing. You have a distorted natural market, domestic market, because you're not integrated into the world market. There are benefits to that in the gas market, which is the petrochemicals business. There's benefits right now. NGL prices have collapsed. That helps the petrochemical market. But these are distortions in markets that, in theory, I don't think most people actually want. I don't think, and I would agree with Michael, I don't think energy independence is a true statement. What we're talking about is a net BTU balance that doesn't mean you're effectively paying a headwind of tax for importing commodities. And I think the way to get to that is growth in oil, growth in gas, growth in wind, growth in solar, and decline in consumption. But I think the interesting point that you make is that if you create a market that's distorted, producers will object to it. And that's true in the natural gas market, which is the $4 gas market won't exist in 5 years' time if you're not allowed to export LNG, because the average finding and development cost for natural gas last year was $2.70 amongst the top 45 E&Ps. The average return on capital employed of Chesapeake Energy in the last 13 years, despite spending $31 billion, is 0%. That tells you something. You don't make money producing natural gas in this market. Now, that won't last forever. It can last temporarily. You've got free money right now. But these are the factors that play into the geopolitical argument when you go out 5, 10 years about independence.
Mr. Shahenshah, would you like to add anything on?
I mean, I think that I'm with that. I think the point about price is very important. It comes back to that. And just think the definition of reserves, of oil reserves, is resources that can be economically recovered. And so the quantum of reserves that you see, whether they're tight oil or conventional, changes with price. And that's, this came to light a few years ago when Shell lost 30% of its reserves. It didn't lose 30% of its reserves, but there was some trickery as well. But I think price is absolutely essential. Now, you can look below into supply and demand, those dynamics and what drives it, and consumption and so forth. But That's why the concept of energy independence in the United States being it's here now and forevermore has to be treated with a great deal of caution.
Isn't that's, for those people who study it, that's a bit of a straw man. It's in the popular discussion of energy dependence, but people, you can define it in ways that it's really not an issue. But on the issue of price, as has been brought out, as the price goes lower, more and more production in the U.S. gets shut in. Do any of you have any strong feelings on where the turning point in the U.S. would be about, $80, $70, $60? Where does it really start to shut the United States down? And if we saw prices drop for whatever the reason, Iran came back in, is this self-correcting in the sense that there are places around the world like Russia, Nigeria, Saudi Arabia that can't tolerate oil at $50, not for very long, and that something would happen there to cause enough chaos that they either drop out and the market corrects but to a higher level, or forces would rally to just get the price higher? That even the United States, I mean, it's not appreciated by a lot of people. There were several times in the 1980s and 90s where the United States actually sent emissaries, Department of Energy secretaries, to Saudi Arabia to argue for a higher oil price. So would this be self-correcting if we saw lower prices?
I think it's important to think of, we learned in 2009 after the Lehman shock about demand destruction, right? But there are supply destruction scenarios, and what you just said was an example of that in the 1980s when U.S. oil production and Soviet oil production at the time collapsed because of the lower price scenario. I think the U.S. is in a vulnerable position for weaker prices, but I think that there's those who are more vulnerable, particularly Canada and Russia, and the East Siberian investments that are taking place there in oil sands that are probably higher cost on the supply curve than most of the U.S. tight oil plays, which are probably in a wide range between like $55 a barrel and $75, right? Whereas the Russian and Canadian stuff is even higher than that. So they would get hit first in the supply destruction scenarios. The good news, I think, for all of those higher cost producers is that their interests are basically aligned with the Saudis at this point, right? You have high cost oil producers and you have high spending oil producers, and then you have producers who are both high cost and high spending, also known as the Russians, right? So they're all looking at trying to keep oil at least $90 Brent. So what we saw at the end of last year was the Saudis cutting production, concerned about Brent and OPEC basket falling below the number that they need to balance their own budget. Now we've had Libyan supply offline, Iranian supply offlines have increased again, but I think the longer term trend is the Saudis trying to manage that downside.
But with WTI at $92, $95, the only place we've seen slight shut-in that I'm aware of is in Canada, in a few smaller places. So clearly $90 isn't enough to start shutting up production. Yeah. So do we lose 2 million barrels at 80 or 3 million at 80? Or is there some number that you would see?
My quick answer to that, I think it's more you lose investment in future supply than there's not a lot. I mean, even the operating costs in the oil sands are, for existing oil sands, you have to go down like 50.
It's some cost. So by the time you have your fixed cost done, you can move forward.
Right. Well, there's an important contrast with the case of the 1980s and 90s that you brought up, because I think a lot of people look to that and say, well, what happens if there is a whole lot of overinvestment here, prices plunge, and then we have this sort of hangover for a decade or two that keeps prices low and radically changes things around the world. I think it's important to look at what the conditions were in the 1980s and 90s. First, you had a lot of production where most of the costs were front-loaded. You spent the money, you built the infrastructure, and then you produced at a very low cost for a very long time. Today, if what we're talking about is being driven by this boom in US production, it looks very different. You invest a lot of money, you produce a lot, the individual investment declines quickly, and you invest somewhere else, you drill somewhere else, and you keep doing it. And so if the price incentive goes away, the production falls off quite quickly to bring the market back into balance.
Let's stop. I would have a slightly different take on that, but let me ask the other panelists. Would you? I mean, certainly with shale gas and oil, that's true. But what about ultra deep, West Africa?
Right.
I mean, it's not quite. Those are big upfront investments.
Those are so small compared to the U.S.
Right.
So you see the US
and we have to be careful if we're talking about the consequences of the U.S. boom. We should be focusing on the U.S.
But I think you have to separate. I would disagree in the 1980s. What was interesting in the 1980s is global spare capacity was around 9 million barrels. You had a temporary disruption driven by geopolitical events, but actually the marginal cost of oil supply hadn't been rising from 1970 to 1984. It had artificially been rising because you had taken low-cost barrels off the market and you had substituted those with high-cost barrels. Even if you look today, with 2.5 million barrels offline through Iran, and multiple other countries, Nigeria, Sudan, etc. that is not a huge buffer that can come back on and materially alter the marginal cost of supply. Yeah, you may see oil prices drop $10, $15, $20 associated with that return of supply, but it's not the 80s, and it was a very different dynamic to them. I think one thing...
You would see this, so the shale oil and gas revolution is the marginal barrel.
I would say one of the things, if you go back and look at elasticity of supply, the US is always the most elastic. Predominantly because A, it tends to be high cost, and B, as the other panelists said, it's onshore. Once I've sunk $5 billion offshore Gulf of Mexico, I'm not stopping producing, but if I've done it onshore, I can. And as Michael said, the decline rate on some of these early curves, you can get 100% of your investment back in 1 year, so shutting the well in some cases makes sense. And I think that's the dynamic that's different. The US historically there's been two marginal producers in the world's cost curve. The US, because it's high cost, and Saudi, because it elects to be. And what you see is if Saudi grows production on the front end of the cost curve, it squeezes out the US on the other end of the cost curve. If Saudi reduces production, the US is allowed to grow. That dynamic has actually been true for the last 30 years, and I don't see it materially changing. And what the US is doing right now, along with Canada, and I would, the oil sands, they say, are harder to turn off, but you're seeing that dynamic continue today, which you have marginal cost of supply that allows operators to get a 15, 20% return. They're doing exactly what they should do, which is growing barrels. And in the event that you saw lower prices, I do believe you'd see the US growth decelerate. I don't know decline, but decelerate.
Would that make it very, would that make you less optimistic about the United States? Because the Saudis have a break-even price, pick your number, 90, 100, 105. It's a high number, so they have to produce and they can't make it up on the quantity if the price goes much lower. So that'd be pretty negative for the US in that world.
I think the difficult thing, the other panelists here will probably have a much better view than me, is that the marginal cost of supply to Saudi is 40% operational and 60% political. So their choice about what price they need to survive is a question of social dynamics as opposed to necessarily operational efficiency.
I think it's a question of internal politics for the Saudis and also external politics, right? They need, I agree with you, social stability. They need that budget at $90, which is the number I would use, to maintain the subsidies that they're giving to the population in a sort of post-Arab Spring environment. But also external, right? The key foreign policy relationships with the US, Iraq, and Iran, right? All significant oil producers, right? Iraq is ramping up production. Maybe sometime next 2 or 3 years we get a change in the direction with Iran and that oil starts to come back online. Does Saudi want another price war with any of those? Or do they work to accommodate and give market share more in the name of political stability to give the Iraqis some market share back, as they did with Angola, a much less politically complicated relationship, clearly. So I think if you were to summarize the world oil market over the next 5 years, at least on the supply side, in a sense, it's Saudi reaction to US and Iraqi and maybe even Iranian production growth.
So there's one important distinction we need to keep in mind. In the 1980s and 90s, we had particularly the 80s, fairly flat demand. We had a lot of demand destruction after the 1970s. Today, we have steadily increasing demand. And that means that in all the fights that we're talking about, you're talking about sharing a growing pie. It's a lot easier politically to share a growing pie than a shrinking
I don't know what I said about growth. I mean, I agree with you. It's growing and it is steady, but it's not as steady as it was in 2007, 2008, right? Europe and Japanese demand is pretty much dead. U.S. is flat, and you got a fuel economy story there. So it all comes down to the non-OECD market, especially Asia and China. So the big question of how China manages their demand on a public policy point of view is going to be interesting. But even before you get to that, China growing at 7.5% versus 9.5% GDP is a different story. So I agree it's steady, but the pie is not really growing fast enough to accommodate the more bullish forecasts.
Part of the popular discussion of oil independence and the geopolitical changes is that maybe this opens up the opportunity for the United States to walk away from the Middle East and Saudi Arabia, to fundamentally change the relationship with Saudi Arabia. But for some of the things that were just said, it actually almost seems that the United States and Saudi Arabia have a common interest, and that there might be a way to work out an understanding on an acceptable oil price that both sides are happy with. Is that something that, Mr. Shahenshah, you're in the region, is that something you see?
Yeah, I mean, I don't see the United States walking away from Saudi Arabia at all. I mean, I think there's a managed relationship, and it's going through a new phase, and to a certain extent, there's almost a negotiation, and who's got more leverage at different points in time. But I think it's in both countries' interest to have a very strong and close relationship. I think in other countries that are not as strong, and this could apply to Venezuela, this could apply to parts of West Africa and some other countries, where there's more of a need for external investment, I see a situation there where those countries are much more vulnerable as a result of the energy revolution in the United States.
If people want to start moving to the microphones, we'll take questions from the audience in a minute or two. But on that note, then, there is a well-appreciated relationship by many people that lower prices make many of these countries more amenable to foreign investment by the IOCs, that they become more accommodating in their foreign policy goals. So if we can see prices down in the 80s or 90s, lower than where they have been, would you expect positive things in Venezuela? I mean, for example?
Well, I mean, to a certain extent, it gets back to the break-even issue, because costs tend to be much stickier than prices. So if we were to see a decline in prices, a fairly rapid decline in prices with costs coming down lower, effectively what happens is investment is curtailed or delayed, and as you know, with oil wells, you don't just turn them off and turn them on. And so there's quite an important lag effect, which there's a knock-on effect where investment is lost for a period of time. So, I see a situation where you could really lose, there could be almost an accelerating loss of momentum, if you will, in certain countries.
I think there's an important distinction, and it came out in what Osman said, between what you said, between the impact of changing prices and the impact of changing trade patterns. Right? So you should see less investment in Nigeria or Venezuela or wherever if the price is lower and the opportunity is the same because the return you get is lower. In the long run, you shouldn't see a change in the investment level just because the oil is being shipped to China instead of to the United States. I think one of the most sort of interesting and difficult questions around what's happening, though, is how does that change in the short run? In the short run, there's a sort of fixed-ish amount of capital available in the industry, and so if it's not going here, it's going there. In the longer run, presumably, if the potential returns are the same, more capital should flow into the industry, and all of that should be exploited. But that short-run dynamic, which can be 5 years, 10 years, those are politically consequential time periods, I think is a place where we haven't thought through enough.
Mr. Dell, on that note, do you see the flows of capital in the industry continuing at the same levels we've seen them? Because it's been staggeringly large.
Well, I think in our view, the escalation in the marginal cost of supply will continue. I mean, the resource pyramid, as it's described, is that you have 1 barrel of very easy oil and 100 barrels of harder oil and 1,000 barrels of even harder oil. I don't think that dynamic changes. And whether your description of hard is technologically hard or geopolitically hard, I mean, I would tell you the Bazhenov shale in Russia is extremely attractive, but I don't know anyone willing to put money in there for 30 years to get the full production back. So I think the amount of capital invested in the oil and gas industry will continue to escalate, and long-term prices will continue to escalate. I think the dynamics domestically via international will be premised around these price cycles. And to comments that have been made earlier, short-term cycles impact near-term investment in new supply. And those have 2, 3, 4, 5-year lag periods that follow them. And we saw that in 98, 99. And it was really the beginning of the escalation in the marginal cost of supply as we started essentially chasing lower quality barrels.
All right, well, why don't we take questions from the audience, and we'll start on this side.
Mr. Shahenshah, I believe, you started the discussion with something very interesting. You talked about Turkey's needs and its next door neighbor, Kurdistan, part of Iraq. I wanted to hear a little bit more about what you thought would be the dynamic there. After all, the Turks have a very nasty relationship. The Turks have a not particularly good relationship with their own Kurdish minority. Are you seeing a trade where they'll support independence in return for a long-term contract, or what do you foresee? You were hinting at something, but maybe I didn't understand it. Or can you talk a little bit more about it?
I don't see an independent Kurdistan. Kurds culturally are present in Syria, Iran, Iraq, and Turkey. So I don't necessarily see that happening anytime soon. The point I was just making is that Turkey is at an interesting location with relationships with an eye towards Europe, an eye towards Russia, Iran, Iraq, and of course Syria. And Israel's not too far away. And to go from it's a rapidly growing economy and a rapidly growing population, to go from a situation of being quite energy dependent to potentially largely energy independent, potentially, due to Kurdistan, due to Kurdish imports of gas and oil, could have a profound change on potentially weakening the Iraqi state and therefore potentially weakening or giving Iran fewer options, which has a dynamic both in Syria and Iran. And that can have geopolitical consequences which could lead to forms of conflict, potentially.
And what about if I may, what about the gas that's underneath the Eastern Mediterranean? How do you see that being played out between Turkey, Israel, and et cetera?
It's an interesting one. Someone said to me the other day that that gas is likely to either go to Turkey or Cyprus, which is, given the population centers, that's somewhat of a contradiction. I see a relationship, developing a commercial relationship probably between the Eastern Mediterranean producers and Turkey, a purely political, a purely commercial relationship rather than a government-to-government sort of close cooperation with peace and joy breaking out anytime soon. But I do see a commercial relationship evolving.
On that note, though, is the Turkish relationship with the Kurds predicated on their being able to contain their aspirations? And is this something that you can take for granted, that Turkey really can contain the Kurds 5 years away from now? They put all this money in, they build all the infrastructure. Obviously, there's a codependency or mutual dependency, but can you take it for granted that the Kurds really will cooperate with the Turks and not reach for too much?
You know, the Kurdistan region of Iraq is a landlocked region. It's got some pretty tough neighbors, Iran, Syria, and Turkey. So I think it's a mutual cooperation arrangement. Thus far, it's worked fairly well, and I would see that continuing.
So you would think that the investments by the IOCs in Kurdistan have been very smart to basically forsake Baghdad and go to the north?
Yeah, I mean, my sense is that Baghdad is heading only in one direction, and the federal government in Iraq can't really allow Kurdistan to go because everybody else wants to go as well. And so I think it's a very fragile stub of a country left, but I think it's fairly inevitable that there will be changes in the future.
And one of the big restraints on the Eastern Mediterranean development is really the Turkish-Israel relationship. I mean, do you have to see a significant improvement in that relationship, or do you think that you can get an understanding on an LNG facility in Cyprus or a pipeline to Turkey without a major improvement in that bilateral relationship?
As I said, I think there needs to be some political improvement, but I think a deal can probably be done on a commercial basis rather than full-blown cooperation, political cooperation between the countries.
So this is a case of Turkey where economics trumps politics in all spheres.
It often does.
Yes. On this side?
Yeah, on that note, on the Eastern Mediterranean Sea, how do you see the fines, whether it's going to be a pipeline through Israel to Turkey, and then maybe in the later years onto Europe, or even a little bit north, or LNG reaching Europe? How do you see like the geopolitical implications of that? Maybe just looking at Russia, gas coming to Europe from there, how that could play out. If the panel wants to give their thoughts on that.
I could say a quick word toward the Russia thing. My basic sense of the Eastern Mediterranean gas picture is that it's very important for that region and for relationships within that region, but it's important when you look beyond that to keep the scale in mind. And in the grand scheme of things, whether it is developments in Middle Eastern supply and trade patterns or US and Canadian supply and trade patterns, those are going to be considerably more consequential for the Europe-Russia relationship than the Eastern Mediterranean developments.
Actually, I'm glad you raised that point, Michael, because the Europeans are going to become much more energy dependent over the next 10 or 15 years. The contrast with the United States is pretty stark. I mean, does this essentially weaken Europe's position in the world because of their increasing energy dependence and their refusal, for example, to allow fracking on their own territory?
I think Europeans are missing an important opportunity if they decide not to develop more of their own shale resources. I think compared to where they were 5 years ago, they're still better off than than previously because there is a greater diversity, or there will be a greater diversity of suppliers in the market. I mean, the primary European geopolitical competition is not with the United States. So a relative change in the US and European positions isn't hugely geopolitically consequential. I think where the difference is on the price of gas. It's commercial. And there are big consequences for the relative competitiveness of petrochemicals and fertilizer. But while important for those sectors, that's not what's going to determine the relative geopolitical positions in the 21st century.
Okay. I'll just add to that. I think there's a lot of dynamics playing out in Europe and Russia that are very interesting, but they really are country by country. For example, France being very nuclear, Germany walking away from nuclear. We have a big position in Germany in Posidonian shale. And I think Germany has been fracking for years and has been a big onshore producer. You have the UK declining and moving more to LNG. But the big underlying dynamic of the European situation, which is somewhat away from the Med, is what really happens with Russian gas, and how does the Russian domestic market, both from an oil stand and gas standpoint, work? You've had a Russian gas market that's been massively subsidized, but you also have a Russian upstream production base that requires huge amounts of incremental capital now to keep volumes up where they need to be, or in fact grow that supply into Europe. And I think the question is, if Russia starts losing market share because of importing LNG or because it's just struggling to supply gas, what does it then do with its domestic gas market? What does that do to Russian GDP? And how does that change the dynamics in the region? And I think each country is going to try and play that differently, but the buyers are trying to become more independent by whatever mechanism they can, and the suppliers, being the Russians, are predominantly trying to keep them on the hook by whatever methodology they can.
If there's a consensus on the geopolitics of the energy revolution, it's that Russia's a loser. Would everyone sort of agree with that? That there's almost no way that Russia could come out of this winning, being better off than it was?
I necessarily agree with that. I think they have a challenging position on gas for sure, for the reasons that were just mentioned. But I think on oil, they actually are doing better than a lot of people think or realize, that they've actually managed to grow production moderately over the last 4 or 5 years. At a time when the bet was 5 years ago, their production would be sinking to 9 million barrels a day. They have offered better terms for some limited IOC opportunities. But the big thing is they've actually figured out a way to work with China. Right, they have done that on oil through the East Siberian Pacific Ocean pipeline. They have not done that on gas with China, which is one reason why the gas sector is in trouble shape.
But we should move on, but that's an interesting point, that they've been negotiating the price of gas for probably 15 years, and they still can't agree on the price. And on ESPO, you're actually impressed with the progress they've made? Because
much more urgency for China on oil than on gas.
I also think they've had no urgency. I mean, you look at Russia, the biggest beneficiary, one of the biggest beneficiaries of rising commodity prices has been Russia, both in terms of its GDP growth. So if you believe in escalating commodity prices, Russia isn't all that badly off. I would argue if you look at the next big unconventional resource, it will be Russia, predominantly because you have the onshore infrastructure, you have the pipelines, but you also have water availability, and you have incredibly rich source rocks. And there's a strong historical relationship between your onshore production, conventional, and what you found unconventionally. That's been the truest statement in the US business. And if you look globally, we're not seeing a shift in where oil production is going to come from long term. We're seeing market dynamic changes. We're seeing the US grow market share because it's developing its unconventionals first. The next generation of unconventionals will be the former Soviet Union, South America, Middle East. The supply bases are going to be the same. It's just the timing of when they come to market. And I personally think the US is going to go through a period of growing market share for 10, 15 years, and then it's going to go back to losing market share. So the question is, how do you benefit from that in the next decade?
I think we're on this side.
Hi, thank you all for coming. My question is about wildcat producers, and I read a story recently in the Wall Street Journal about a former CEO of BP who was in Somalia with a small producer, and he was negotiating on a subnational level with Somaliland to start producing oil there. And I was wondering if you see that as a growing trend, and if so, what are the geopolitical implications?
Well, I would say that I think, leaving aside the Somalia part of it, but putting that in a larger context, I think that what we're seeing in markets like that is that in the peak oil period of sort of 2002 to 2008, when prices were rising, there was intense competition for those kinds of opportunities, right? big national oil companies from China, Russia, India, et cetera, all the super majors, all the big independents. Now, you probably have a better view than I, but it seems to me that a lot of those players have exited those kind of opportunities, and it is these more wildcat or opportunistic, junior to intermediate E&P companies that are moving in, especially in Africa, but also places like Southeast Asia, Central Asia as well. So that's one characteristic of, I think, that we're moving more to a post-peak oil world where supply is still tight, but it's not quite the panic that it was 5 years ago.
Yeah, I mean, what I would add to that, I fully agree, but in a sense, what you want to have happen is what happened in the Gulf of Mexico 20 years ago and what happened in the North Sea 15 years ago, where the creation of a secondary market. When fields were not really appropriate for the super majors, the secondary market was formed where smaller independent companies could come in and make money and continue to invest. And it's helpful to see that around the world, wherever it occurs.
I think that's right. I think that's right. The tricky geopolitical question is, I think there are two. One is, are these guys as disciplined? So do they do things that have broader reverberations that we might not love? I know that if you look at the Chinese and how they invest around the world in resource production, the big companies do okay. The medium and smaller guys, this isn't in the oil world, but in other resources, go off and do all sorts of interesting things that cause diplomatic headaches for China. The other question is, and I don't really know the answer to it, but if it's smaller American companies doing these kinds of things, are they as identified with the United States politically as when Exxon or Chevron or Conoco goes into one of these places? Even though these are private companies, what they do does rebound on the U.S. image and on the U.S. relationship with these countries. So as you see a changing industry structure, I wonder if you see interesting changes in people's impressions of the United States.
Let me frame that a little differently and ask Mr. Shahenshah, because we still, to a large extent, live in a world of sovereign states, where the people who have the monopoly on the use of force have a pretty big say in what happens. Is this something that the United States, insofar, and the UK, insofar as most of this is coming out of, it might be hidden domiciled in places that are not first identified with the US and UK, but ultimately the US and the UK and a few other countries, national governments would have a huge ability to control this if it chose to do so, to change the pattern of investment of these so-called wildcatters. Is this something that Washington or London should be concerned with, or let them go do what they want?
To be honest with you, I think governments think of it as small beer, frankly. These are dozens of small, generally poorly capitalized companies that are going into difficult places and occasionally causing awkward, embarrassing situations for their home governments, but generally it's really around the edges of any kind of sort of geopolitical dynamic.
I would agree with that with two exceptions, which are Afghanistan and Pakistan. Right, that's where the State Department takes an enormous interest in what are fairly marginal resource opportunities.
But you wouldn't put Kurdistan in that list. There's certainly the State Department had to be happy with what's happened in Kurdistan.
My own perspective, and others may be closer to mine, is that the State Department has not been able to influence that particularly effectively, where they have been able to do more so in Afghanistan and Pakistan, probably because they're dealing with smaller players.
Okay.
Walter Goldstein. We had a fascinating visit last week from Dr. Tanaka-san, the director of the International Energy Agency, who looked at this, as he admitted, from the perspective of his Japanese background, the only major economy without any fuel source, and how badly, how gloomily he viewed the notion that prices were going to keep going up despite the increase in supply, which was still very much open demand, and the great vulnerability of the sea lanes. And most of his emphasis went to gas lines, particularly the gas lines from Central Asia going across China, possibly to the Pacific coast of Russia, but always with the notion of how does it end in Japan, with a very gloomy perspective as to Japan becoming the really high-cost producer and not of energy, but manufacturers in the rest of the world. The point that I think that he was raising is that when you're talking about the uncertainties not only in supply, but especially in price, that puts an entirely different perspective on the recent American jubilation of energy independence and so forth, which doesn't ring quite correct, though I like the correction that one of you made, that America is likely to become independent on a BTU balance rather than on oil, gas, or anything else. But with this notion that
Walt, did you have a question?
It's not global trade, it's regional trade that's going to become so dominant. Is this a perspective that you share, or do you think that this might produce in itself one or two of the answers we're looking for?
Michael, it's probably for you.
Sure. I think we already are in a regional gas market. I guess the question is, will we move into a more regionalized oil market? I think superficially, the answer is probably yes, but I don't know that it goes too deep. And the analogy I like to, and that's just because you'll have a bit more of a match between production and consumption, let's say in the Americas, and then between the Middle East and Asia. But for the purposes of sort of how the world responds to disruptions and big geopolitical events, I'm not sure that we would be so regionalized. And the picture I tend to keep in my head is, so imagine that there are a few gas stations in my city. I go to the one near my house, you go to the one near your house, Jonathan goes to the one near his, and then all of a sudden, my one is closed one. So we're regionalized. If you look at the picture of trade, we're regionalized. But if my gas station is closed one day, I just go to the other one, and I'm fine. Because actually, we are integrated, even though we're not going off and crossing lines all the time. I think it's roughly the same picture. You might see the static image of trade patterns look regionalized, but we'll still be integrated because we'll be able to arbitrage across different regions in the event of a disruption.
The last question over here.
Yeah, I'd like to hear some insights on two issues. The first being Brazil. A few years ago, it was, let's say, in the headlines in terms of its pre-salt potential and deep water. We've seen with the auction recently that it hasn't really attracted the attention it can be expected. I'd like to hear if that's particularly due to how the attention shifted basically to North America and those resources. So that's the first question. The second one would be on China. Of course, we've mentioned China. We're talking about geopolitics, but we know it's the main source of demand. But what do the Chinese think? How do the Chinese see what's happening? How do they feel in terms of their energy supply vulnerabilities, and how can we expect them to act based on their assessment over the next few years?
Yeah, I mean, I would make a first comment on Brazil. One of the things about the Brazilian exploration business is it's extremely difficult, both technologically and operationally. And when you first find a discovery, there's the euphoria of, well, we found billions of barrels. And then there's the reality of, well, how do I get it out the ground? And truth be told, subsalt exploration is expensive, complicated, dangerous. And we've seen that both in the Gulf of Mexico, we've seen it in Brazil, and ultimately I think you'll see it in West Africa from a geological standpoint. From my perspective on the shift from Brazil to the US hasn't really been driven by anything associated with the US. It's just a reality in Brazil that it's become harder to operate, coupled with some political changes that have made it hard to do business. I think when you look at the China situation, China's fascinating. We haven't really talked about it in the sense that China's very short, both minerals, both oil and gas, and I think in the future, water. And people talk about the unconventional boom in China. I'm a great disbeliever in that because historically onshore China's not been a big producer. And I think what you're seeing China do is trying to secure resources on a global basis, and it's using its national entities to go and buy those oil and gas barrels in the ground through deals in South America, West Africa. And what's kind of interesting to me is we haven't really seen China emerge as a major player in the Middle East. They have in Iraq, Kurdistan, etc., but they haven't really tried to throw their weight around and secure the resources there. And I do think one of the implications of the discussion we've had is that if you do see the US withdraw more from the US, and I don't necessarily think that's the case, but if you do, I do think China's going to try and flex its muscles because it's a great way for them to secure the resources. And it would essentially be the US and China switching places.
Just quickly on Brazil, I think it's worth saying that the presidential election next year, I think there'll be changes to the pre-salt framework after the election in terms of they don't want to walk back a framework that the Rousseff government put a lot of time into building over the last few years and basically saying it was a failure. I think after the election, looking at the lack of interest in the pre-salt bid round, they'll have to move at least moderately towards more flexible terms, more attractive terms to account for all this exploration risk and development risk that you mentioned. and maybe loosening local content requirements, maybe giving Petrobras a little more flexibility so it doesn't have to be the lead operator on everything. But I think they do realize that the world has changed and that we're not in a world of ever rising prices where they can get the terms that they would want under more bullish conditions.
Maybe a couple quick things on China. I think first we need to be careful when we talk about China securing resources. And most of the oil that Chinese companies produce overseas is not shipped back to China. It's sold onto the market at whatever the best price these companies can get is. And the companies aren't securing it in order to satisfy downstream needs. They're securing it because, like other big oil companies, they like to invest and build up their reserves so they can make more money. Now, from a state perspective, having that sort of financial vertical integration, even if you don't have physical vertical integration, can be reassuring. But there isn't actually much evidence that that's how the Chinese leadership thinks. When it comes to the US boom, the Chinese leadership is puzzled. They're trying to figure out how we are going to respond. They're trying to figure out how players in the Middle East will respond. And so they're puzzling through it just like we are. I don't think they have particular reactions yet because they're still trying to understand the situation. Last basic point on Chinese oil security. Their big fear when it comes to the United States is still that the United States will cut off their access to oil during a conflict, particularly a conflict over Taiwan. And that the US oil boom doesn't change any of that. That was a reality for them, it remains a reality, and it remains a big concern.
On that cheery note, we're going to have to end to stay on schedule, so please join me in giving our speakers a hand. Thank you very much.